It's time for Mike on the Money. Inflation is on the rise again with the war in Iran ongoing. Yesterday, we learned consumer prices rose by 3.8% in the past year. Today, a report on inflation for businesses showed wholesale prices are up 6% in the past 12 months. Mike Giordano with Williams Wealth Management. Let's discuss what this means for your money. How much of these price increases is due to the war?
A good portion. Yeah, I mean, a good portion. And what you're seeing right now is it's the energy prices that are rising substantially because of the war. So you're seeing energy prices, you're seeing gas prices. No one needs me to tell you that the price of the pump have gone up. The part that can continue, even if this, as this thing rolls on, is all the bottlenecks this creates. Mm-hmm. You know, even if the Strait of Hormuz gets open tomorrow, global supply chains have now been wrecked for a few months. And so it could take months and months and months to get those things back online the same way they were before the war. So we could see those kinds of prices funnel in here into future inflation reports.
And oil is all speculation, right?
That's right. Yeah, I mean, so much of oil prices, you're looking at like how much people are bidding up the price today and what do they think is going to happen in the future. Initially, when the war started, it was a lot about what's happening in the first month, second month. But now, as it's continued, you're starting to see prices rising for November, December, those further out contracts.
People are wanting to gas up the car and travel more. Right. People are wanting to fly. We saw flights out of some airlines in Europe were saying they didn't have enough gas. Yeah. So they didn't know what was going to happen with the flight. So this is a global
without question. Yeah, without question. I mean, honestly, the United States, because we have this energy independence, has been a little bit insulated more than Europe, Asia to this point.
How might this affect interest rates?
Yeah, so you're already seeing long-term interest rates rising. 10-year treasuries hit almost 4.5%. You're seeing 20 and 30-year treasury bonds now up over 5%. So those have significantly risen. Now the question is, what happens with short-term rates, the ones the Fed controls? We saw Kevin Warsh today was confirmed as the Fed chair. So he's going to inherit a real dicey situation because he might want to cut rates, but it's going to be a little challenging if inflation stays as persistently hot as it is. But this obviously affects, you know, home buyers, other borrowers as they're trying to figure out, like, what do we want to do? Should we take a mortgage right now or should we wait?
Yeah, so you got home builders out there building, trying to buy property and build up. But then if mortgage rates are so high, you don't have buyers and these homes are sitting there and someone's got to pay for all that.
Yeah, this is the challenge. I mean, if you're looking to borrow money right now, it's a real push and pull because we've seen rates coming down. So if you're using your HELOC, right? Home equity line of credit, that's been more favorable today than it was 2 or 3 years ago. But if the Fed were to start hiking rates, and it's a big if right now, I mean, the policymakers at the last meeting were kind of like all over the place. So they're not really saying they're going to hike rates yet. But if you were to see this war continue, if you were to see inflation continue to drag on, it could be, you could see rate hikes.
What about investments?
Yeah, investment's real challenging in this environment. You remember 2022, that's when we started this whole segment, and that's when the market started, you know, having real meltdowns as the Fed was hiking rates. Well, if you remember, inflation was really getting going in 2020, 2021, and the markets were fine in 2021 because the markets can do really well in an inflationary environment because, hey, if you're buying stocks that are growing substantially, they can do well in these environments. Where they run into a problem is when the Fed starts hiking rates and trying to slow down the economy. So that's why you're seeing right now AI stocks, the tech stocks, they're doing exceptionally well. They seem to be impervious on what's happening with the war, what's happening with energy prices. But if the Fed were to have to start hiking rates, it would be a factor. So the key thing here for everybody out there, this is the central question if you're an investor, is how much money do you put into these AI, these growth stocks, versus how much do you kind of diversify? And if anybody has specific questions, they can go to MikeOnTheMoney.com and I can answer those more specifically for them.
Mike, thank you so much for being here and sharing your insight.
Absolutely.